Look, I need you to pay attention to what just happened in the silver market, because if you're stacking physical metal right now, the game just changed in a way most people aren't seeing yet. And I'm talking about a fundamental shift that's been building for months, finally breaking through in a way that's going to catch the mainstream completely off guard. Let me start with what everyone's focused on. Gold just hit new all-time highs. Again. The headlines are screaming about gold at $2,700, $2,800, breaking records. Central banks are buying, institutions are piling in, everyone's watching gold. But here's what they're missing while they're staring at the shiny object. Silver just did something it hasn't done in over 3 years, and the implications are massive. Silver broke through a technical resistance level that's been capping this market since 2021. We're talking about the $32 level that's acted like a brick wall every single time silver tried to push higher. And it didn't just touch it and fall back like it's done a dozen times before. It smashed through, held above it, and is now using that former resistance as support. That's not just a technical breakout, that's a complete reversal of market structure. Now, why does this matter to you as a stacker? Because what's driving this move isn't speculation. It's not retail FOMO. It's not even the gold rally pulling silver along for the ride. What's happening underneath the surface is a supply crisis that's been years in the making, finally colliding with demand that's accelerating faster than anyone predicted. Let me paint you the picture of what's really going on. Global silver mine production peaked back in 2016. We hit about 900 million ounces that year, and we haven't been back since. Production has been declining or flat for almost a decade now. Meanwhile, industrial demand has been climbing every single year. Solar panels alone are consuming over 200 million ounces annually now, and that number is projected to hit 300 million by 2027. Electric vehicles, 5G infrastructure, medical devices, water purification. Every major technology trend of the next decade is silver intensive. But here's where it gets interesting. The solar industry just announced build-outs that are 40% larger than previous projections. China's expanding their solar capacity faster than anyone anticipated. Europe's accelerating their green energy transition because of the energy crisis. The United States just passed legislation that's going to supercharge domestic solar manufacturing. And every single one of those solar panels requires about 20 grams of silver. Do the math on what happens when you're adding hundreds of gigawatts of solar capacity, and each gigawatt needs roughly 75,000 ounces of silver. Now layer on top of that what's happening in the investment space. Silver ETFs have been bleeding metal for 2 years. Investors have been selling, prices have been suppressed, sentiment has been terrible. But in the last 6 weeks, something flipped. We're seeing consistent inflows again, not massive yet, but steady. And here's the thing about silver ETFs. When they buy, they have to buy physical metal. They can't just create it out of thin air like paper contracts. Every share represents actual silver bars sitting in a vault somewhere. So you've got declining mine supply, surging industrial demand, and now investment demand starting to wake up. But wait, there's more. The COMEX warehouse stocks, the actual physical silver available for delivery against futures contracts, just hit the lowest level since 2016. We're talking about roughly 270 million ounces of registered silver, which sounds like a lot until you realize that's only about 3 months of global industrial demand. And a significant chunk of that is already spoken for, already allocated to specific contracts. Let me tell you what happened in March of 2020 that nobody talks about anymore. When COVID hit and everything shut down, the silver market broke. Not metaphorically, it literally broke. The spread between paper silver prices and physical silver prices exploded to $8 per ounce. You could sell a silver futures contract for $12 and buy physical silver for $20. That's not supposed to happen in a functioning market. It happened because there was no physical metal available. Refineries were closed, mints were shut down, logistics were frozen, and everyone who wanted physical silver couldn't get it at any reasonable price. The market eventually normalized, but here's what didn't change: the structural deficit. The Silver Institute's been publishing reports for years now showing that silver demand exceeds supply by over 100 million ounces annually. That deficit gets filled by above-ground stocks, existing inventory, recycled silver. But you can only draw down inventory for so long before you run out. And we're getting close. Now I want you to think about what happens when the investment community figures this out. Not the silver bugs who've been stacking for years. They already know. I'm talking about the mainstream financial world. The hedge funds, the family offices, the institutional money that's been ignoring silver because it's been a dead trade for 3 years. What happens when they look at the supply-demand fundamentals and realize there's a genuine shortage developing in a market that's tiny compared to gold? The entire silver market is worth maybe $1.4 trillion if you include all the silver ever mined throughout human history. The gold market is worth over $15 trillion. Apple's market cap is bigger than the entire silver market. When institutional money decides to allocate even a small percentage to silver, there's not enough metal to absorb that demand without prices going significantly higher. And here's where the gold-silver ratio comes into play. Right now, it takes about 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. During bull markets in precious metals, it often drops to 40 to 1 or lower. In 2011, when silver hit $49, the ratio was 31 to 1. If gold's at $2,800 and the ratio drops to even 50 to 1, you're looking at $56 silver. At 40 to 1, you're at $70. And those aren't crazy numbers. They're just historical mean reversion. But let me bring this back to what's happening right now, today, in the physical market. Premiums on silver coins and bars have been elevated for months. You're paying $4 to $6 over spot for American Silver Eagles. Generic rounds are $3 to $4 over spot. That's not normal. In a healthy market with plenty of supply, premiums are $1 to $2. High premiums mean one thing: physical shortage. Dealers can't get enough product to meet demand, so prices go up. I've been talking to dealers who are telling me their suppliers are running low on inventory. Mints are operating at full capacity and still can't keep up with orders. The U.S. Mint has been rationing Silver Eagles to authorized dealers because they can't produce enough blanks. And this is during a period when silver prices have been relatively quiet. Imagine what happens when prices start moving and FOMO kicks in. Now, here's something most people don't understand about the silver market. It's not like gold where you have massive central bank reserves that can be mobilized to suppress prices. Central banks hold about 35,000 tons of gold. They hold essentially zero silver. Governments sold off their strategic silver reserves decades ago. There's no official sector that can dump supply into the market to cap prices. It's purely a supply-demand equation. And right now, that equation is tilting heavily toward shortage. Let me tell you about what happened in 1979 and 1980, because there are some eerie parallels. The Hunt brothers tried to corner the silver market. They accumulated over 100 million ounces of physical silver and silver futures. Prices went from $6 to $50 in less than a year. Now, I'm not saying someone's trying to corner the market today, but I am saying that when you have tight physical supply and increasing demand, prices can move a lot faster than people expect. Silver's a small market. It doesn't take much to move it. And here's the thing about silver that makes it different from almost any other commodity. It's both an industrial metal and a monetary metal. When the economy's strong, industrial demand drives prices. When there's financial uncertainty, investment demand drives prices. Right now, we're in this unique situation where both are happening simultaneously. The economy's transitioning to green energy and advanced technology, which requires massive amounts of silver. And at the same time, we've got inflation concerns, currency debasement, geopolitical tensions, and a growing distrust of the financial system driving people toward hard assets. Think about what's happening globally right now. The BRICS nations are actively working to reduce dollar dependence. They're talking about commodity-backed currencies. Russia and China have been accumulating gold for years. If there's any move toward using precious metals to back or partially back currencies, silver's going to be part of that conversation, because there's not enough gold to go around. Silver's the poor man's gold, but it's also the practical choice for any system that needs to facilitate actual commerce. Quick aside here. If you're sitting on retirement accounts worth $100,000 or more, and you're thinking about how to protect that wealth from what's coming, I put together a free guide on how gold IRAs work. It's in the description below. Covers the whole process of getting physical precious metals into your retirement account without triggering taxes or penalties. Worth checking out if you're in that situation and want to understand your options. Anyway, back to where this market's headed. The technical breakout we just saw in silver isn't happening in isolation. It's happening at the same time that gold's making new highs, at the same time that mining stocks are starting to outperform, at the same time that the dollar's showing weakness. This is the kind of setup where everything aligns, and when everything aligns in the precious metal space, moves happen fast. I want you to understand something about how these bull markets work. They don't move in straight lines. Silver especially doesn't move in straight lines. It consolidates for long periods, frustrating everyone who's holding it, making people question whether it's ever going to move. And then, it explodes. In 2010 and 2011, silver went from $18 to $49 in less than a year. That's a 172% gain in about 8 months. In 2020, it went from $12 to $30 in 4 months. These moves are violent and fast when they happen. And here's what triggers them. It's not fundamentals. The fundamentals are always there. The supply deficit's been there for years. What triggers the moves is a shift in perception. It's when the market suddenly realizes that the fundamentals matter. When the narrative changes from silver's a dead trade to silver's in shortage. When momentum traders pile in. When algorithms start buying. When retail investors see prices moving and don't want to miss out. We might be at that inflection point right now. The technical breakout is the signal. The fundamentals are the fuel. And the macro environment, inflation, currency concerns, geopolitical instability, is the catalyst. You put those 3 things together and you get the kind of move that changes portfolios. Now let me address the elephant in the room. What about a recession? What if the economy tanks? Doesn't that kill industrial demand for silver? Here's the thing. Yes, a severe recession would hurt industrial demand. But it would also trigger massive monetary stimulus. Central banks would print money, governments would run huge deficits, and that's when the monetary demand for silver kicks in. People flee to hard assets when they lose faith in paper currencies. So even in a recession scenario, silver has a bid. And if we don't get a recession, if the economy stays resilient or even accelerates, then industrial demand keeps climbing, the supply deficit gets worse, and prices go higher for fundamental reasons. Silver wins in both scenarios. It's one of the few assets where you're not making a binary bet on the economy. You're making a bet on supply and demand imbalance that exists regardless of the economic cycle. Let me give you some specific numbers to think about. Global silver demand in 2024 is projected to be around 1.2 billion ounces. Mine supply is around 830 million ounces. Recycling adds maybe 180 million ounces. That's a deficit of roughly 190 million ounces that has to come from somewhere. It comes from existing stockpiles, from ETF liquidations, from drawdowns in warehouse inventories. But those sources are finite. At some point, the market runs out of buffer stock, and prices have to rise to either stimulate more supply or destroy demand. We're seeing signs that we're approaching that point. Warehouse stocks are declining, ETF liquidations have slowed and are starting to reverse. Recycling rates are already high. There's not much more silver to squeeze out of that source. And mine supply? It takes years to bring new mines online. Even if silver prices doubled tomorrow, you wouldn't see significant new supply for 3 to 5 years. That's the lag time in mining. So you've got a market that's structurally short, with no quick fix on the supply side, and demand that's accelerating. The only variable that can balance the equation is price. Prices have to go high enough to either ration demand or incentivize enough recycling and secondary supply to fill the gap. And based on the fundamentals, we're not talking about $35 or $40 silver. We're talking about prices that are significantly higher than where we are now. Here's another angle most people aren't considering. The energy transition that's driving solar demand, it's not optional anymore. Governments around the world have committed to net zero targets. They've passed legislation. They've allocated trillions of dollars. This isn't a trend that's going to reverse because silver prices go up. They need the solar panels. They need the electric vehicles. They need the infrastructure. And all of that requires silver. So, industrial demand is relatively price inelastic at this point. They'll pay what they have to pay. Now think about what that means for investors and stackers. You're competing with industrial users who have no choice but to buy. And you're competing in a market where there's not enough supply to go around. That's the setup for a sustained bull market, not just a quick spike. I want to talk about what's happening in China, because it's important. China's the world's largest silver consumer. They use about 200 million ounces a year, mostly for solar panels and electronics. But China's also been accumulating precious metals. Their central bank's been buying gold every month for over a year. And there are reports, unconfirmed but persistent, that they're also accumulating silver through state-owned enterprises. If China decides that silver's strategic, if they start stockpiling it the way they've stockpiled other critical materials, that alone could absorb the entire global surplus. And it's not just China. India is another massive consumer. They use silver for jewelry, for industrial applications, and increasingly for investment. Indian households hold an estimated 25,000 tons of silver. When silver prices start moving, Indian buying accelerates because they view it as a store of value. So you've got two of the world's most populous countries with strong cultural affinity for precious metals, both increasing their consumption. Let me bring this back to you as a stacker. What does all this mean for your strategy? First, if you've been waiting for a pullback to add to your stack, you might not get one. The technical breakout suggests the market's ready to move higher. Second, the risk-reward here is asymmetric. If I'm wrong and silver goes back to $28, you're down 10%. If I'm right and silver goes to $50 or higher, you're up 60% or more. That's a trade worth taking. Third, physical silver is different from paper silver. When the shortage really hits, when premiums explode like they did in 2020, having physical metal in your possession is going to matter. You can't eat a futures contract. You can't hold an ETF share in your hand. Physical silver is the real asset, and in a shortage, it's going to command a significant premium over paper prices. Now, I'm not telling you to go all in on silver. I'm not telling you to bet the farm. What I'm telling you is that the setup right now is as good as it's been in years. The fundamentals are there, the technicals are confirming, the macro environment is supportive, and the market's giving you an opportunity to position yourself before the mainstream figures it out. Think about the investors who bought gold at $1,200 in 2018 and 2019. Everyone thought they were crazy. Gold had been dead for years. It was a barbarous relic. And then 2020 hit, and gold went to $2,000. Those investors who bought when nobody cared made 60% in less than 2 years. Silver's in a similar position now. It's been dead money for 3 years. Sentiment is terrible. Nobody's talking about it. And that's exactly when you want to be buying. Here's the final thing I want you to understand. The silver market is tiny. The entire annual supply of silver is worth maybe $30 billion. That's less than the market cap of dozens of individual companies. When real money decides to flow into silver, there's not enough supply to absorb it without prices going significantly higher. And once prices start moving, once momentum builds, once the narrative shifts from shortage to crisis, the move is going to be fast and violent. We're watching the early stages of that shift right now. The technical breakout is the market telling you something's changing. The supply-demand fundamentals are telling you why it's changing. And the macro environment is telling you this is just the beginning. So if you're a silver stacker, if you've been accumulating physical metal, if you understand why hard assets matter in a world of infinite money printing and currency debasement, this is your moment. The market just flipped in your favor. The question is whether you're positioned to take advantage of it. The next few months are going to be critical. Watch the $32 level. If silver holds above it, if it uses that former resistance as support, that's confirmation the breakout is real. Watch the premiums on physical silver. If they start expanding, that's telling you the shortage is getting worse. Watch the ETF flows. If investment demand really starts accelerating, that's the signal that mainstream money is waking up. And most importantly, watch what you do with this information. Because opportunities like this don't come around often. When they do, the people who act early are the ones who profit. The people who wait for confirmation, who wait for everyone else to figure it out, they're the ones who end up chasing prices higher. Silver stackers just got the market flip they've been waiting for. The only question now is what you're going to do about it.